Alrighty, gang. Good morning. It's August 22, 2025. Okay, we're gonna see the goal, see what he's doing. All right, for today. But first, disclaimer. And second, and most important, subscribe. If you like what you see, people, I do this every day, once in the morning and once in the afternoon, to have a perspective of where we're going. Okay. Right now is 1:20 a.m. So if you like what you see, subscribe, people. It's free. You don't spend one penny, and it could be very useful. All right. Now, let's see what we see. All right. Gold, U.S. dollar. Okay, what do we see? That's not fair. You already saw my position. People, I'm doing this. I'm not joking around. This is my position to the downside, and you can see I'm going down. All right. Now, how I got to that conclusion? Let's check it out. Let me take this out of there. Okay. First step in this process, please learn this. Reduce the graphic to minimum expression so you have a sense of prospecting. All right. Prospectus. All right. All our analysis is based in the fundamental of movement. What is that? Impulse and retracement, impulse and retracement, impulse and retracement. That is the main structure of the market. It doesn't matter what it is, it doesn't matter the time frame. That is essential. Without that, there will be no market. All right. And what is the reason for that? The reason for that is the war between buyers and sellers. Buyer and sellers. I don't talk about us, retailer traders. We are nothing in the volume of business that is happening. These are financial institutions, banks, maybe investment groups that have millions of dollars and are capable to cause turn in the market. Us, civilians, we have no use, okay? So every time you analyze an impulse, it's not a joke, all right? Let me release the brakes in here. You can see it all the time. Impulse, retracement. Impulse establishes trend to the downside. Look at this. Look at this movement here. All right? Movement are not to infinitum. They have a limit. And we can see here that none of this peak ever went back to this point. Can you see that? Never breached this point. One of the rules is the price don't breach the high point, the trend is moving in the direction it's moving to the downside in this case. Let me mark this, okay? So when you understand what I'm talking about. This peak never passed this level. Trend is moving to the downside. Okay. Here, bump into it, continue to go down. Can you see it? Look how much time you can find these things. Look at this. Look at this. Never went above this point. This never went above this point. So where the trend is going, people? You need no indicators to trade. But they sell you the idea. Oh yeah, you buy this indicator and I tried 200 times and I have made millions of dollars. People, if you learn this, please listen to me. I have nothing to gain with this. I make enough money to live like a king doing this. All right? I'm doing this for one primary reason. Trading, when it's doing for real, is extremely boring. So the other day I was like, man, I do this analysis anyway. Let me put it on the internet. Who cares? Who cares? We're irrelevant in the market. All of us as a trader can win every single day, and we do nothing to this market. And we should understand how big this thing is. Okay, so what do we have? This is moving down. You see the same repetition here, here, here. This price is unable to go up as far as today at freaking 1 o'clock in the morning, 1:32. You see what I'm talking about? No indicators. You already know this thing is going down. Now, I'm not against indicator, but you have to use it in the context of the main structure of the market. If you'll be done if you don't do it this way. All right? Because you have to use everything in the context of the movement in the market. All right? So this price is going down so far. Now, this was a stream. I don't go that far. It's not necessary. But what I do every day, I track this market every day. Look how beautiful this. If you can then identify this with uh, uh, with time, buy. Look how many buys. Why? Because you buy down here, people. Now, what happens to neophyte, new in the traders? They buy oscillator. Uh, the drawdown of the how you call it? Indicators. I'm sorry, I'm drinking a little water. Is that they are behind in time. How many times you take a signal for an indicator and turns against you 1,000 pips, 100 pips, 300 pips? And the reason for that is you are buying or selling in the wrong spot and almost immediately reverse against you. This is the reason. But with this simple thing, there are indicators that mark these points. You know what? Let me show you this because it's really cool. All right. The indicators and tell you this is the highest point, this is the lowest point, this is the highest point. Let me see if I can find it. I found it the other day. I say, holy crap! But I have a lot of lines. But let me do it just for fun. All right. Where is this thing? What was the name? Right here. Watch this. Boom! Now I am too far away and look very confusing. But this tell you because the power of this indicate of this zigzag is not actually doing trade. You don't want to enter in here. You don't want to use this to enter, even though when you have the experience over here, there's a nice signal right there. My signal come from another way. I'm going to show you later. Let me get them out of there. You see, impulse retracement, impulse retracement, impulse retracement, impulse. So you can identify this with this type of indicators. All right, this is the high point. Did it ever went up? No, 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 no. The thing is going down because either go down or up. Can you see how cool is this? I'm not against indicator. Use it in the context of the fundamental movement of impulse and retracement. Look how beautiful this is. This is a buy signal here. Buy, buy. Wow. If you don't know this, people, you're trading blind. Please learn this. Oh boy. Oh, there we go. All right, let's go back to our thing. So we have this is another tool that I use because sometimes I use my preferred tool is a standard deviation channel. Why? Because it's a I try to trade level. A standard deviation channel is a statistical measure of whatever you're using for. My wife is a lab technician. She told me, yeah, we use a standard deviation for certain cases, certain races suffer or certain things more than other races, and we can identify that with a standard deviation. Now, it had to be adapted to whatever you're doing. In this particular case, we're using price, and we are that the uh, I use linear standard deviation and polynomial standard deviation. Okay, linear is what it says, one line. We're going to put it right here now. All right. Now, sometimes the numbers don't fall exactly up here, but guess what? It's another tool. Watch this. I bet you didn't know this. Channels, standard deviation channel. Boom. I'm there. What am I looking for? This point here. What is this price going? All right. Where is this price going, people? To the downside. You can have an entrance right there, which I already did. Trade level. You see it right there? I just put that in. Look at my target and the bottom of this channel. Right? Now, let's use a more complex. This is cool because you can actually get this point and this point, then you can actually see. People use your eyes. You have the eyes are powerful too. Can you see the trend moving to the downside? Price never breached this line. The same concept. All right. Sometimes I like automatic situations. Sometimes I use manually. Can you see the trend, people, moving to the downside? Now, let's plot the actual standard deviation automatic. Take a little bit of a gain to capture certain points because the amount of candles, 4 candles, are, if you don't know the 4 candle yoke, look it up. You're going to die laughing. Standard deviation, let's say I use Fibonacci numbers, let's say 233. Too short. I want to get it at least up here. All right. 233. Let's say 610. I'm drawing the channel, but okay, people, what do you see? This beat any indicator. You can make this shit up. Look, people, impulse retracement. Stop at the 1.6 standard deviation line. How this work? When the price hit the first, let me plot the third one here. Normal standard deviation is 1, 2, 3. Now you adapt it to what you're using for. I believe the, damn, what was it, 610? There we go. Now let me explain to you how this works. When the price touches the first line, there is about 55 to 60% that the price will bounce from there. The second line is about 70. Can you see it? First one, second one. If the price hit the third line, the probabilities of bouncing is better than 90%. So what we see here, coming down like it's hot, you can actually see the movement going to the downside. Can you see it? People, please learn how to measure the market. Then you mess with the indicators, all right? Now, watch this. I'm going to blow your mind a little bit here. Have you seen the hurricane projections recently? Well, I have a tool that is very similar to that. And it's a spaghetti group of lines that tell me the projection forward. Remember, traders, what we do, we look at the past and project it to the future. Now, watch this. I'm going to go down one step here. This is part of experience doing this. All right. Now let me see if it works. We're gonna do 1,000 candles in the past to the downside, crystal clear. 2,000 candles in the past. Spaghetti, 3,000 candles in the back. You see that? I have 1,000, 1,000 point of beginning, 2,000 pounds, 2,000 pounds. Let me go back to 1 hour. Let's see what happened. People, what is this movement going according to the spaghetti projection? These are 1,000 hours. That's 42 days. This is 80 something days. This is way, way back there. And what do we know? The heaviest the data is. Look at this. The most accurate is. This is February, people. It take all these candles to project this to the downside. You see the use of the indicators as the context of what you measure. You do it later. Now, do I have an oscillator too? Let me plot it in here. I don't want to erase the channel. Let's erase my spaghetti projection. This is a polynomial channel. We take the past, project it to the future. At the same time, identify points of support and resistance because this use standard deviation. This is 1.6, 2.6, 3.6. You can see it. You can actually see this happening. All right. Now, gee, man, I forgot the track. What are we going to do? Oh, oscillator. Let's bring an oscillator, which is very common. People use oscillators, and every time they go in, the thing bounces. Let me see what we have here. See that? Impulse, retracement, impulse. So you can use an oscillator to enter. In the context of this, impulse. Oh, let me put it. Property. Property chart in the foreground. Okay. Impulse, retracement, and you enter here. Sell. What's the problem with that? You already know this is moving down. You enter here, 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 and here. Where am I? Let me see. Right there. Let's get a little close. You see, this is the way to use indicator in the context of the measurement of what you're doing. All right. You already know that the trend is down. The trend move in the price move in trend and oscillation. You see the oscillation here? Sell, sell, sell. People, please listen to me. I'm not selling you jack. If you learn how to measure the market in the context of impulse and retracement, you will be 1,000% more effective. So what we have for today, we have gold going down to my standard deviation in here. That's about 385 pips. Not too bad. All right, again, this is what I see in the gold US dollar. Bye.